the market share of precious metals and precious metals investments in the United States relative to all forms of savings and investment assets stands below 0.5%, which is to say gold and silver and precious metals related assets, mining stocks and the like, comprise less than 0.5% of all the savings and investment assets in the United States. That's down from a 4-decade mean of 2%. I believe, because of quantitative easing, debt and deficits, and negative real interest rates, that we will at the very least revert to mean. And if I'm right, that means that demand for this asset class will quadruple.
Rick Rule is a highly renowned and seasoned investor, speculator, and founder of Sprott Global Resource Investments, a global alternative asset manager focused on precious metals and other commodities. According to Rick, a frequent speaker at industry conferences and interviews on natural resource investments, this is the best time to be an investor in the natural resource space. Rick believes that as a result of various economic and macro factors, the demand for precious metals like gold and silver will quadruple in 2024, as soon as the rest of the investment world realizes the master plan. This purported master plan has been the core subject of several precious metals-related interviews and conferences since central banks started buying at an almost unprecedented rate in 2021. For decades, these apex banks sold their metals and loaded up on US Treasuries, so their sudden policy reversal drew the attention of several well-known investors and commentators in the space. It didn't take long for experts like Rick to connect the dots between the extremely chaotic economic conditions in the United States and central banks' sudden urge to move away from the dollar and into precious metals like gold and silver. However, Rick is optimistic that come 2024, central banks will not be the only categories of investors buying these metals at an unprecedented rate. He believes more investors, including money managers, pension funds, family offices, and others, will hurry to increase their exposure to gold and silver. As a result, Rick believes we could see the demand for these metals quadruple before the year ends. We will now bring you clips from Rick Rule's recent interview with Wealthian. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. You can also check out our other videos on gold, silver, and other precious metals. Thanks and enjoy the video.
People say to me fairly frequently, Rick, when is the gold price going to move? I began increasing my own personal inventories in 1999. And if you look at the period 2000 to 2023, the price of gold has gone from $250 to over $2,000. So when people ask me when the price is going to move, I would say 2020. It's been moving for 23 years. It's been moving well, below perhaps their expectations, and their expectations matter not to me. Now, gold moves well, historically, moves well, by well I mean to the upside, when investors are concerned about the maintenance of their purchasing power in conventionally denominated instruments, fiat instruments, in particular important fiat instruments like US dollar instruments. And I believe that investors have a reason to be concerned going forward. In fact, several reasons. The first reason is quantitative easing around the US dollar. James, if you did it, quantitative easing would be called counterfeiting. If you produced wealthions and tried to buy bread with them, they'd put you in prison. But if you were a member of Parliament or a member of Congress and did the same thing, you'd be elevated to hero status. Irrespective of the politics, quantitative easing, which is printing more currency without increasing the backing, is in fact counterfeiting. And each existing counterfeited unit does not increase the value of the units that came before it. But a second cause for concern, I think, a second reason why people need to consider owning gold is the credit quality of the debtor, which is to say debt and deficit. But in the US, the on-balance sheet liabilities of our government, that is, the debts expressed by Treasury securities, exceeds $33 trillion. But that's not the worst of it. The worst of it is the off-balance sheet liabilities, the net present value, not nominal value, the net present value of entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, the Environmental Trust Fund. These numbers, recourse obligations to the taxpayer, exceed, by the estimate of the Congressional Budget Office, $120 trillion. So at the federal level in the United States, not including state and local governments, we owe each other, or rather, the spenders owe the savers, some number over $150 trillion. And we're addressing this debt with a budget that's in deficit $2 trillion a year. By the way, before the impact of higher interest rates on the servicing of the government debt. This should make any saver in US dollars concerned. But I think it actually gets a little worse, and that's the specter of inflation. Many of your listeners will believe that inflation is under control. Inflation is measured by the CPI. But I don't think that the CPI is a measure of the deterioration of the purchasing power of your currency. In the first instance, James, the CPI is hedonistically adjusted, which is to say that the imputed value of your computer or your house is determined by a cabal of big thinkers who control the index. Of course, when it is inconvenient, the index doesn't include food or fuel, which I guess would be relevant to me if I neither ate nor drove, but I do. But the strangest part of the CPI as a cost of living index is that it doesn't include tax. For working Canadian and American households, tax is their largest cost of living, larger than shelter, larger than food, larger than transportation, and larger than energy combined.
The Fed's inflation metrics have always been sources of controversy among experts. Policymakers say that excluding food and energy items from core inflation measures is important because these items tend to go up and down in price dramatically and often. But expert analysts like Rick believe this is just another tool to hoodwink people while keeping the real inflation figures hidden. Last year, when official data showed U.S. inflation was close to hitting double digits at 40-year highs, several experts said they believed real inflation was already above 12%. Last week, the Federal Open Market Committee estimated that there will be 3 rate cuts in 2024, meaning it believes inflation is under control, and Americans are no longer losing adequate purchasing power every time they buy something or pay for a service. However, Rick says the U.S. dollar is still constantly losing about 7% of purchasing power every year. Let's get back to the video.
I believe that the basket of goods and services I purchase means that the purchasing power of my savings is declining at about 7% compounded. So if you think about the concern I might have as a saver in U.S. dollar denominated instruments, let's do the arithmetic. The U.S. 10-year Treasury is, of course, the benchmark security and the benchmark saving asset worldwide. That instrument purports to pay savers 4.3% in a currency that I suggest is declining in purchasing power by 7% compounded, which means that if I lend the U.S. government money for 10 years, in other words, I buy the U.S. 10-year Treasury, I am losing 2.7% of my purchasing power every year compounded for 10 years. Now, what is it on earth that could make me more concerned about the efficacy of saving in U.S. dollars than an absolute government guarantee that they're going to take 2.7% of my wealth away from me every year? For those reasons, I believe I have to own gold. But there's a little more arithmetic, James, I want to leave your audience with. The market share of precious metals and precious metals investments in the United States relative to all forms of savings and investment assets stands below 0.5%, which is to say gold and silver and precious metals related assets, mining stocks and the like, comprise less than 0.5% of all the savings and investment assets in the United States. That's down from a 4-decade mean of 2%. I believe, because of quantitative easing, debt and deficits, and negative real interest rates, that we will at the very least revert to mean. And if I'm right, that means that demand for this asset class will quadruple. And I think it'll do that in 5 years. You'll remember that I mentioned the year 2000 as being the year when the gold price move started. And I think that's useful too. People spend too much time wondering whether the price of gold will break 2000 or will break 2200. I own it because when gold gets on the metaphorical bicycle, it really moves. In the period 2000 to 2011, it moved from $250 an ounce to $1,850 an ounce. I don't own gold because I think it might go to 2,500. I buy gold because I'm afraid it'll go to 8,000 or 9,000. That's why I own gold. It's important to note, too, that you don't have to go overboard. Gold is a form of insurance that when it pays off in spades. So the purchase of a little bit of insurance buys you an awful lot of coverage over time. Imagine the holder of gold in 2000 owning gold as to, 4 or 5% of their portfolio, seeing the price of gold go up sevenfold. It would have taken real damage in other parts of the portfolio for gold not to have been able to do its job and shelter the holder's purchasing power. I've been forecasting for 45 years, like most other forecasters. My long-term precise forecasting track record is unblemished by success. But I will continue to hold gold as long as we have quantitative easing, as long as we have debt and deficits, and as long as we have negative real interest rates. I can tell you that I sleep better at night holding gold than not. So while I don't have a specific price target, when I think about the efficacy of gold relative to other asset classes like long bonds that I might hold, I'm very, very comfortable on the gold side of the trade.
According to Rick Rule, when investing in precious metals, it is important to have a long-term time horizon and stick to your investment strategy, regardless of fluctuating market conditions. It is obvious that we are in very uncertain times. The economy is showing more resilience than everyone expects, yet government debt continues to spiral out of control. And there will be more uncertainties and chaos ahead. This is why investors like Rick Rule are advocating a return to trusted hard assets like gold and silver that have stayed true to their fundamentals for centuries. What are your thoughts on Rick Rule's interview and his analysis of the current economic situation and market conditions? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.